This is the Daily Gold University. Welcome to lesson number 9, all about junior gold and silver stocks. Let's get into it. A junior resource company is involved in exploring, discovering, or developing a new mineral deposit that could become a producing mine. Juniors are speculative venture-style companies that, while extremely risky, serve as the mining industry's research and development arm. Juniors are trying to discover and define the next future mine. Like a biotech company is trying to develop the next blockbuster drug, or a tech startup trying to become the next Amazon or Microsoft. Junior resource stocks are listed mostly in Canada on the Toronto Stock and Toronto Venture Exchanges, London on the London Stock Exchange, and Australia on the Australian Stock Exchange. The size of a junior company varies depending on your perspective as well as the current stage of the company. Investors and speculators in Canada and Australia view a junior as anything below $100 million in market capitalization, even below $50 million in some cases. They tend to focus on the industry's smallest companies, primarily exploration stage companies. These companies are exploring to discover a mineral deposit or drilling to grow an existing deposit to a larger size. Some of these companies can be classified as pre-resource or pre-discovery. These companies carry the greatest risk but the greatest reward. Only 1 out of 1,000 exploration projects becomes a mine. Some projects are never drilled. However, due to growing interest in their tiny size, these stocks can move from pennies and nickels to $1 or $2 in a raging bull market. The ones that do make a major discovery that will become a significant mine, and I can think of only a handful in the last decade, can return 100-fold from their IPO price. Investors and traders in the United States view juniors through the GDXJ exchange-traded fund. It is the most liquid and widely followed ETF for junior resource companies. GDXJ has been rebalanced in recent years, and its top holdings are mid-tier firms rather than juniors. A longtime Canadian analyst, Bob Hoy, once called GDXJ the senior juniors. The top 20 holdings in GDXJ comprise roughly 60% of the fund and have market capitalizations of at least $2 billion. That does not sound junior to me. If one removed the top 20 companies, GDXJ would better fit its description. Yet it would still be focused on the largest and most successful junior companies. GDXJ is composed of juniors who become successful producers and juniors who are developing or building significant mines. There are no pre-resource or pre-discovery companies within the GDXJ. There are a few exploration companies, but only those that have already discovered or defined a meaningful deposit. Let us discuss the stages of junior companies in greater detail. Most juniors are exploration companies. These companies are searching for a new deposit, greenfield projects, or hoping to grow an existing deposit, brownfield projects, to reach critical mass. Some companies may have already defined a resource, while others are just getting started. When a company moves from publishing a resource estimate to an economic study, such as a preliminary economic assessment or a pre-feasibility study, it can become a development company. The development phase involves preparing for and actually building a mine. This stage involves infill drilling, filling in areas between known mineralization, permitting, and a definitive feasibility study. A company reaches the latter stages of development when it raises the funds to build the mine and begins building it. If the mine's construction is successful, the junior company becomes a junior producer. Figure 9.1 is one of the most important charts for understanding the evolution of a successful junior mining company. It was created by Pierre Lassonde, a former president of Newmont and the founder of Franco-Nevada. The chart depicts the life cycle of a junior resource company, also known as the Lassonde Curve. It shows the potential path of a stock price through exploration, development, and production. While every junior company won't necessarily follow the Lassonde Curve, it does help us understand where the risks and opportunities are. The major takeaway for investors and speculators is there are 2 buy points and 1 major sell point. The best times to buy are before or during a legitimate mineral discovery or during the final months of construction leading to production. The major sell point is between these 2 stages when the company enters development and has to prove to the market and industry that the discovery can become a mine. We want to buy exploration companies before they have maxed out their exploration potential, and developers near the end of the development period around the time construction begins. A successful exploration company will either be acquired by a larger company or successfully develop the asset independently and build the mine. A successful development company will raise the capital needed to build the mine and then build it successfully. Acquisitions occur most often at the development stage because the project has been de-risked. Lobo Tigre, the editor of The Independent Speculator, has deemed the buy point on the Lassonde Curve for developers the pre-production sweet spot. Tigre studied the outcomes of 124 first-time mine builders, dating back to the 1980s. The majority of cases are gold and silver mines, but the data includes some copper and uranium mines. He found an operational success rate of 92% and 95.2% if a mine was built after a takeover. In assessing stock performance, Tigre compiled performance from a published construction decision or announcement that construction had begun to the announcement of first pour or reaching commercial production. The average time from construction decision to first pour was 569 days. Overall, 75.4% of those cases delivered a positive return. The average gain from the construction decision to first pour was 97%, and the average gain from construction decision to an announcement of commercial production was 111%. The average gain was 132% during bull markets against a 20% gain during bear markets. Why focus on producers and developers? There are multiple reasons why I prefer to focus most of my research on developers and producers, and you should too. These companies offer the best value proposition. The market loves growth, and production growth offers leverage upside in a bull market. As we have seen from the Lassonde Curve, the best point for owning developers or producers is near the end of a mine's construction when production is only months away. These companies receive a valuation bump or positive re-rating from construction to production. Producers and developers have more predictable outcomes than earlier stage exploration companies. It is much easier to project the value of producers and developers 2 or 3 years into the future at various metals prices. One can estimate the level of production, the gold price, and potential cash flow. Meanwhile, exploration companies are entirely dependent on the success of drill holes, which is much less predictable. They are also not necessarily leveraged to metals prices. Their leverage is based on their exploration success more so than metals prices. Side note, this is extremely important. Exploration companies that have not defined a meaningful deposit yet and have less than 2.5 or 3 million ounces in the ground are not as leveraged to metals prices. Very important. Finally, you can invest in exploration by also investing in producers who commit to serious exploration. This is a lower risk way of investing in exploration. These companies can fund exploration from their ongoing cash flow. Exploration companies have to continuously issue shares to fund their exploration, which becomes extremely dilutive if they are not adding significant value with each raise. Meanwhile, suppose a producer makes a discovery near or around an operating mine. In that case, it can add significant value to the company because the capital required to mine that new discovery is usually extremely low. They often do not need to build a new mill or processing facility. The mining infrastructure already exists. Generalist investors may recall Kirkland Lake Gold, which moved from below $2 a share in late 2015 to as high as $50 a share in 2019 and $57 a share in 2020 before being acquired by Agnico Eagle in 2021. Kirkland Lake Gold played a large role in multiple high-grade discoveries at the operating Fosterville mine in Australia. The company acquired Newmarket Gold in late 2016, which discovered the ultra-high-grade Swan Zone. Crocodile Gold acquired Newmarket Gold in late 2015, which discovered the high-grade Eagle Zone at Fosterville. Side note, that's a mistake. It was Newmarket Gold who acquired Crocodile Gold. By 2019, Kirkland Lake Gold grew the Swan Zone to 2.34 million ounces at a grade of 49.6 grams per ton, making it likely the world's highest grade gold deposit of that size. Production at Fosterville grew from 123,000 ounces of gold in 2015 to a whopping 619,366 ounces in 2019. The mine, with a cash operating cost of only $119 an ounce in 2019, generated nearly $650 million in operating cash flow, almost 20-fold greater than the cash flow it generated 4 years earlier. Wesdome Gold is another example of discovery that transformed a junior producer. In 2016, it discovered high-grade gold mineralization in the deep zone of an old mine, Kiena in Quebec. After the gold price peak in 2016, the stock climbed from $1.70 per share in late 2017 to $14.85 a share in 2020. By the end of 2020, the Kiena Deep discovery had grown to 835,000 ounces at a grade of 17 grams per ton. A gold discovery need not be 2 or 3 million ounces to be transformational for a producer or developer. In many cases, a small, high-grade discovery of 500,000 ounces or even less can materially raise the economics of a development project or add significant value to an operating mine. Kirkland Lake Gold and Wesdome Gold are a few examples of what I deem the holy grail of junior mining. This is when a junior resource company boasts production growth potential with a significant value-adding mineral discovery from exploration. Criteria for selecting producers and developers. Broadly speaking, I am looking for junior producers and developers with the potential to appreciate by 5 times to 10 times in a cyclical bull market. That entails looking at companies with market caps below $200 million that have the potential to grow to $1 billion and $2 billion, and for companies with market capitalizations below $1 billion that have the potential to become $3 to $5 billion companies. I usually avoid companies with market caps below $50 million and those that are essentially penny stocks. The following criteria apply mostly to producers and developers, but also relates to exploration companies. Management. Many who speculate on or invest in junior companies say that management is the most important criteria. The odds of success in this game are fleeting, and those who have had success in the past are most likely to have success in the future. Management should have a track record of success when developing, building, and operating mines. Have they built mines? Have they worked in operations for a senior mining company? Are they seeking to build the type of mine that they built in the past? In exploration companies, management teams with a track record of success have better odds of future success. They can attract strong backing, raise capital, and acquire the most prospective projects. It is important to note that success in exploration can be quite elusive. Unknown geologists can make tremendous discoveries, while those that have in the past may not necessarily find success in the future. A track record is important, but do not overvalue it. The biggest names in the industry do not have a bulletproof track record. While they tend to come across the most prospective opportunities, success is never a guarantee. At the same time, many grifters run companies for the paycheck and do not do serious exploration. Size. Size matters. Larger mines and larger projects attract more attention and investors and command a valuation premium. Those investors include fund managers, large institutions, and industry professionals. Larger mines and larger projects also have greater leverage to the upside of a bull market. There are important thresholds. At a minimum, we should focus on companies or projects that contain or have the potential for 3 million ounces of gold and the potential to produce at least 100,000 ounces of gold per year. For silver, we focus on companies or projects that contain or have the potential for 80 million to 100 million ounces of silver and the potential to produce at least 8 million ounces of silver per year. And as far as silver equivalents, we are focusing on silver and gold and not base metals. Many silver deposits contain other base metals like zinc, lead, and copper. But with respect to silver projects, gold is valued far more highly than base metals. The market cares about and values a producer growing production from 100,000 ounces of gold per year to 225,000 ounces a year more than a producer growing production from 25,000 ounces a year to 75,000 ounces per year. The plus 3 million ounce of gold threshold is important for exploration because if these projects have high margins, they will attract big money investors and interest from senior mining companies. One can make money on smaller discoveries and production growth from smaller projects, but there is more interest, money, and potential in the larger deposits. Value. Speculators and investors should first value a company and its potential based on the current gold or silver price. Every project, mineral deposit, and operating mine will appear to be a great investment at a much higher gold and silver price. Focusing on value at only higher metals prices can lead you away from real value and real companies with good prospects. Besides, if a company is at a good value at the current gold or silver price or slightly lower price, the odds are that it will be a big winner in a bull market as metals prices move higher. Producers, developers, and exploration companies are valued differently. As already covered, the greatest valuation bump comes from moving from a late-stage developer to a producer. Hence, we prefer to focus on junior developers and junior producers. One of my favorite areas for finding value is among underpriced developers likely to fund and successfully build a mine within the next few years. Perhaps the developer is trading below 0.20 times its net present value. If it funds and successfully builds the mine, it can trade closer to 1 times net present value a few years later. If the real price of gold moves higher, there is additional upside. The 3 drivers of price appreciation in junior producers are production growth, valuation, and margins. The ideal situation is to find a junior producer with production growth potential and the potential to trade at a much higher valuation when that production growth is attained. A rise in the real gold or silver price will result in stronger margins. Those 3 things can lead to massive appreciation over a few years. Insider and institutional ownership. Insider and institutional ownership are important for 2 reasons. First, it reduces the float, the supply of stock actively traded, which for juniors will grow over time due to the need to raise capital by selling additional shares. A tighter float makes it easier for a stock to rise. Second, it adds credibility to the junior. Institutional ownership also includes ownership by a larger mining company. Ownership from the CEO and board of directors signals those at the highest level are aligned with shareholders and believe in the company's outcome. Avoid these fatal flaws. Few mining properties are viable. Even fewer, 1 in 1,000, become mines. This is because a fatal flaw or 2 prevents the project from ever being financed and built into a mine. Some of these fatal flaws emanate from a single broad flaw, which, other than permitting difficulties, usually makes the project uneconomic. The reasons can relate to the deposit size, grade, or capital needed. A common flaw is that the deposit's grade is not high enough. This is especially common with very large deposits. While the large endowment of gold or silver will excite some investors, the broader market ignores the size because it knows the low grade will prevent the deposit from ever becoming a mine. Also, huge deposits typically require massive capital investment to become mines. No one will fund a billion-dollar construction if a project is marginal. Investors and financiers cannot assume the gold or silver price will rise and change the economics because that tends to be temporary and unsustainable over the mine's life. They want to fund projects that can work even if the real gold or real silver price does not rise. Some gold and silver deposits may have more than adequate grades but are too small. The market does not care much about small deposits. Moreover, because of cost inflation, building a small mine today is quite a bit more expensive than it was decades ago. A smaller project can only work if the potential margins are very high. Some mines, especially underground mines, have technical or execution risks. There can be many reasons why a mine won't work. For example, a deposit's mineralization may be too narrow, making it too difficult to mine. It may not have enough continuity. There may also be too much dilution from mining the ore to transporting it to the mill or processing facility. Open pit mines tend to have lower execution risk, but good metallurgy is essential, as those mines are lower grade and require strong ore recovery. Bad metallurgy can doom these types of projects, as it can entail rocks that are too hard, costly, and difficult to recover ore from. Permitting risk or jurisdictional risk is a major fatal flaw, much greater than it was 20 years ago. In layman's terms, this means the project will never be built or will struggle to be built because it will never be allowed by local or national governments. For example, it is nearly impossible to permit a new mine in California. This is also known as political risk. Permitting and jurisdictional risk can also entail environmental risk and the risk of terrorism, which is a problem in parts of Africa. It is important to note that jurisdictional risk is never a reason to focus solely on the best jurisdictions. You risk investing in many marginal projects and perhaps questionable companies. Many of the best discoveries and projects are located in places some investors deem undesirable and risky jurisdictions. The most successful speculators and investors in this space keep an open mind. Others only focus on North America and therefore miss out on some of the best opportunities. Side note, this is extremely important and a common mistake that amateurs make. They focus way too much on jurisdictional risk, confining themselves to small areas and lots of marginal projects. Note that jurisdictional risk tends to be much greater before a project is developed and operating. Once it is permitted and operating, far more stakeholders are involved in the mine's success. Why focus on juniors? Junior resource companies are a better option for investors or speculators seeking growth and capital appreciation, provided they spend significant time analyzing the viable companies in the space. Juniors have far greater upside potential and leverage in a cyclical bull market, while senior miners do not necessarily possess a material advantage in protecting against the downside. Neither should be held throughout a bear market like blue chip stocks. Here is some data from the last secular bull market in precious metals. From 2004 to 2007, GDXJ gained 299%, while from 2004 to the peak in early 2008, GDX Parent Index gained 187%. During the global financial crisis, GDX declined 71%, while GDXJ lost 81%. Then, from the 2008 low to the 2011 peak, GDXJ surged 578%, while GDX gained 311%. It's also possible for individual and retail investors to gain a significant information advantage in various junior companies. Many small juniors and even medium-sized juniors lack analyst coverage. Retail investors can become experts on these companies. In many cases, you can communicate with the company's CEO. You can become better informed on these companies than most market participants. That is not possible with the senior mining companies. Furthermore, retail investors have a liquidity advantage. Big money cannot buy or sell these companies without having a huge impact on the market. It has to be married to the stocks. Ultimately, the potential for significant and sometimes life-changing returns in juniors seduces us the most. In Figure 9.2, we plot the performance of a basket of 12 to 15 gold-focused juniors over different time frames. Interestingly, the two baskets appreciated around 13-fold over the first 3 years. The performance from 2008 to 2011 is more than double of that of GDXJ. In Figure 9.3, we plot the performance of a basket of junior silver stocks over several different periods. The last two cyclical bulls, which lasted multiple years, 2008 to 2011 and 2005 to 2008, gained 9-fold within 3 years. Unlike the secular bull market in precious metals from 2001 to 2011, the current one, which is just beginning, has the potential to evolve into a bubble and mania, which would entail much higher returns than in the 2001 to 2011 period. In Chapter 5, we noted the two major similarities between the new secular bull market and the bull market of the 1970s. Unlike in the 2000s and the 1930s, bonds are now in a secular bear market as they were from 1965 to 1982. Also, like in the 1970s, gold and silver will have broken out to new all-time highs early in their new secular bull market. The preponderance of new all-time highs in gold and silver over the years ahead will lend itself to more speculation. It is nearly impossible to find data on juniors' historical performance during the secular bull market of the 1970s. Still, the intrepid Jeff Clark of the Gold Advisor uncovered data on quite a few companies. Figure 9.4 shows the performance of 15 juniors in the final 15 to 24 months of the 1979 to 1980 mania. The average gain was 24-fold. There were other periods aside from 1980 when juniors were caught up in a mania or bubble. Several major mineral discoveries were made in the mid-1990s, which uncorked a frenzy in junior exploration companies during a cyclical bull market in resource companies from 1993 to 1996. Figure 9.5, also courtesy of Jeff Clark, shows the performance of 15 exploration companies during a modest bull market for commodity prices. Another mania occurred in junior stocks on the Spokane Stock Exchange in the 1960s. Silver rose from 90 cents in 1960, breaking above the 1920 high of $1.32 an ounce to $2.55 an ounce in 1968. Also, don't forget that the Barron's Gold Mining Index broke out from a 26-year base in 1964. Spokane, Washington was the corporate headquarters for most of the region's gold, silver, lead, and zinc mines. According to HistoryLink, a free online encyclopedia of Washington state history, the average penny stock appreciated 160 times. In quoting from HistoryLink, the post-World War II period saw not only restoration of its original name, but the admission to the trading floor of additional mining entrepreneurs, including Benjamin A. Harrison and Harry E. Magnuson. These two were able to take advantage of the silver boom of the 1960s, during which the average penny stock appreciated 160 times. Participation in the Spokane Stock Exchange was vast, with more than 100,000 investors from all 50 states and many foreign countries. Barron's declared speculators in silver stocks here struck it rich in Spokane. In the Seattle Post-Intelligencer called Spokane the speculative darling of the industry. Harrison's obituary describes him as president of the Spokane Stock Exchange for 12 years, and its most knowledgeable mining stockbroker. The mining stocks Mr. Harrison traded brought immense wealth to northeastern Washington and northern Idaho. And here's a chapter summary before we get into additional material on silver stocks. Chapter summary. Junior resource companies are highly speculative venture-style companies that function as the research and development arm of the broader mining industry. They seek to explore for, discover, and in some cases build the mines of the future. There are thousands of these companies, and most are involved in exploring an asset to discover a future mine or grow an existing deposit. The vast majority of these companies are not viable and should be ignored. Because exploration is very risky, we focus mostly, but not entirely, on the companies building a mine and/or growing production. One can also invest in exploration by investing in junior developers and junior producers who continue to fund exploration programs. Many, but not all companies, will follow a life cycle, also known as the Lassonde Curve. It shows that there are only 2 times to buy a junior company: before or during a major discovery, and in the development phase when a company is building a mine and several months away from starting production. There are key criteria to evaluate when researching individual junior companies. A management team with experience and a track record is almost essential. One should focus on projects and mines that have potential to be large. The big money in this industry focuses exclusively on those assets. One should also evaluate a company's potential based on current metals prices. Otherwise, you become too dependent on the rise in metals prices. Juniors are enticing because they will significantly outperform in cyclical and secular bull markets. They can offer significant leverage to rising metals prices. Senior mining companies are more stable, but can experience catastrophic declines like juniors in a cyclical bear market. If they do their homework, retail investors can become experts on individual juniors, which lack analyst coverage and are not well understood by most investors. Finally, the outlook for precious metals is extremely positive, raising the odds of the potential for a mania at junior resource stocks. And now, we add to this lesson with more information on silver and silver stocks. We are going to talk about silver stocks and what we look for in explorers and producers. So, there's 3 most important criteria when we're evaluating junior silver exploration companies and junior silver developers. You have size, grade, and the likelihood of becoming a mine. These are the 3 most important things. Let me go through the details of each. Size. The market and industry want big projects. The minimum threshold is 80 to 100 million ounces of silver or silver equivalent, because that means that a mine can likely produce around 8 million ounces a year for 10 years. Again, gold counts toward that threshold. Base metals do not. This helps avoid projects with a smorgasbord of metals dressed up as silver equivalents that contain too little silver and gold. Base metals, as part of a silver deposit, are far less valuable than gold. Rick Rule recently mentioned that he wants to see a minimum of $10 billion in recoverable ounces. I think he was talking about Tier 1 silver projects. At the current silver price, that is around 300 million ounces of silver or silver equivalent. We will consider that the next threshold. So you got your 2 thresholds there. So for small exploration companies, we want to look for the smaller deposits that have the potential to grow and become 80 to 100 million ounces of silver. The other opportunity would be look at the companies that have exceeded that threshold but still have some room to go and the potential to get to that Tier 1 level of 300 million ounces of silver or silver equivalent or greater than that. So that's number 1. Moving on, let's talk about number 2, grade. Now, the bare minimum should be 150 to 200 grams per ton of silver. Now, we're not counting oxide projects. That's different. So ideally, we'd like to see 300 to 500 grams per ton grade silver or silver equivalent. Now, again, gold and silver are the most valuable here, but base metals mineralization boosting the grade actually is fine. it's far more valuable in terms of boosting the grade than really contributing to the size of the deposit. Now, having these extra metals, that does introduce more metallurgical risk, so you have to pay attention to that. So metallurgy is very important when looking at this. So that's number 2. Now, the last one, there's a high likelihood of the project becoming a mine. Now, this is where we really separate the pretenders from the contenders. This is also where a plethora of risks are introduced. Will the project be permitted? Is it good enough to be funded? How is the metallurgy? Just talked about that. Again, many of these projects are polymetallic, which introduces significant metallurgical risk. So they have to check. If they can't check off that box, that's bad. Now, is the mineralization thick or wide enough? There are silver deposits out there where they have a lot of high grade, but the mineralization is so narrow that it's just hard to mine. Like, you can't profitably mine like 1 to 2 meters of mineralization that's 400 or 500 meters below the surface. So this is another problem that these companies can encounter. And so the likelihood of becoming a mine, if you're a newbie in the sector, you have to talk to people and know people that can help you figure that out. I mean, it requires a lot of experience to know that. And why is my stock not performing well? It's usually because there's some hidden flaws and it's not going to become a mine. Okay, so summarizing the criteria. Now, I was just mentioning it there. This can help explain why certain projects are valued more highly than others. It's all about the economic potential. Obviously, size and grade, and will be a mine. That's it. That's right there. So big, high grade, and will be a mine. If a company or a project only marks 2 out of 3, the market doesn't care, and then you have an optionality play. So the absolute biggest winners will be those projects right now. Let's say they have less than 40 or 50 million ounces of silver, but they end up growing well over 100 million ounces. That's one. And then also, in addition to that, I mentioned, there's projects out there that already meet the 3 criteria. They're still attractively priced and have significant upside. So that's the good news. Now, last thing I'll mention, I'm just going to get into valuations. I think this is in the bonus chapter in the book, but there's a couple others. But I love these charts here. What's so great about this is an RBC report from October 2024, and they covered 50 silver stocks. So when we're looking at developers here, this is exploration and developer silver stocks. 27 stocks went into this. Now, this is producers. So this is, I think, 23 or 25. And so this shows, this is simple. Historical, what's the value of their ounces in the ground? Now, 7-8 months ago, $1 an ounce for, again, this is 27 companies. Now, we obviously want to own the ones that have the most valuation upside. And something I'll mention, this peak right here, which was $1.50, looking at the higher grade, I did a premium update on this, looking at the higher grade in the best developer, they were valued at this point at $3, and some of them were valued above $3 an ounce. So remember, this is an average. This includes lots of stocks that I personally wouldn't buy. And so this is an average for producers. And it's interesting because, what do you think will happen when the silver price breaks above 35 and goes to 50 and then goes above 50 like this? We're going to see these lines move up significantly. And again, we want to be in the stocks that are going to move from a valuation of, 2 or 3 or $1 an ounce in the ground to then they become worth $5, $10, $15 an ounce of the ground. So that's the opportunity. On that note, I'm going to wrap up this lesson. I may do a separate video outside of the lesson, just expanding upon the silver stocks there and what I talked about. But thank you all for tuning into that very long and important lesson number 9. Next up, this will be a shorter lesson, trading and investing rules for junior resource stocks. Thank you so much for joining us for lesson number 9. I look forward to seeing you for lesson number 10. Stay strong. You're almost done. Just got a couple more lessons.